What should you consider as alpha in investments? How is Jensen Alpha different from alpha? To enlighten you more on such intriguing investment concepts, we have our financial expert Mr. Hariharan with us. Hariharan, over to you.
This is what all of us want in our investment, right? We want alpha in investment. Now, what is alpha? What we generally know as alpha is what is the extra returns that my fund has delivered as compared to the benchmark. Okay, this is what most people know alpha is, but I'm going to talk and introduce you to something which is very interesting, which is called Jensen's alpha. Now, to explain that, let's look at the table there, which is there, which will explain it. So let's assume I got two large cap funds, A and B, and both have the same benchmark, which is Nifty 50, and the Nifty 50 has delivered 10% returns. Now, actual returns that is delivered by fund A is 12%. Actual return delivered by fund B is 14%. So what alpha we normally look at is extra returns over the benchmark. So benchmark is 10, fund A has delivered 12. So my alpha is 2%. Fund B has delivered 4% alpha. So what I would do, I would go and choose fund B because it has delivered 4% alpha, right? I'm going to share something very interesting, which is Jensen's alpha. Now, what Jensen's alpha says that every fund takes a risk, and for the risk that it takes, there is an expected return from the fund. Compared to that expected return, what has been the actual return? And then you subtract that and figure out what is Jensen's alpha. So now you look at A. Let's say fund A has an expected return of 11%. Fund B has an expected return of 15%. Why it has got a higher expected return? Because that fund manager has taken higher risk. Therefore, the expected return, there's a formula to calculate that. I'm not getting into that formula. So that fund is supposed to deliver 15%. Fund A is supposed to deliver 11%. What A has actually delivered is 12. What B has delivered is actually 14. So now you see, the moment you apply the concept of Jensen's alpha, the expected return, your decision will change. Because now when you compare actual versus expected, fund A has still given you 1% alpha, whereas fund B has given you -1. Because it was supposed to deliver 15, it has delivered 14. Again, going back to that point, you and I, when we invest in an equity fund, we assume a risk. That fund managers taking risk. Are we getting rewarded for the risk? So all these parameters, especially Sharpe and Jensen alpha, is going to tell us, are we getting rewarded for the risk that we take?
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.